Welcome to our deep dive into the world of hedge funds and their investment strategies. Hedge funds are often seen as mysterious players in the financial markets, known for their complex tactics and impressive returns. But what exactly sets them apart from traditional investment vehicles? In this video, we'll unravel the core strategies that hedge funds use to generate profits, manage risk, and stay ahead of the curve. Whether you're a finance enthusiast or just curious about how big money moves, this journey will give you a clearer understanding of the sophisticated methods behind hedge fund success. Start with the basics. What is a hedge fund? Unlike mutual funds, hedge funds are private investment partnerships that pool capital from accredited investors. They have more flexibility in their investment choices and can use a wide range of financial instruments. Hedge funds aim to deliver absolute returns, meaning they seek to make money regardless of whether markets are rising or falling. This flexibility allows them to pursue unique strategies that aren't always available to traditional funds, making them a fascinating subject for investors and analysts alike. One of the most common hedge fund strategies is long-short equity. In this approach, managers buy stocks they expect to rise in value long positions and sell stocks they expect to fall short positions. By balancing these positions, hedge funds can potentially profit in both bull and bear markets. This strategy helps reduce overall portfolio risk and allows managers to focus on stock selection rather than market direction. It's a classic hedge fund tactic that showcases their ability to adapt to changing market conditions. Market-neutral strategies are designed to eliminate market risk altogether. Hedge funds using this approach balance long and short positions so that their net exposure to the market is close to zero. The goal is to profit from the relative performance of individual securities, not from overall market movements. This strategy is particularly attractive during periods of high volatility, as it seeks to generate returns regardless of whether the market is up or down. It's a sophisticated way to focus on pure stock-picking skill. Global macro is a strategy that takes big-picture economic trends into account. Hedge funds using this approach analyze global economic and political events to make bets on currencies, interest rates, commodities, and equities. These funds often take large positions based on their macroeconomic views, aiming to profit from shifts in global markets. This strategy requires a deep understanding of worldwide economic forces and the ability to act quickly when opportunities arise. It's high risk but potentially high reward. Event-driven strategies focus on profiting from specific corporate events, such as mergers, acquisitions, bankruptcies, or restructurings. Hedge funds analyze how these events will impact the value of a company's securities and position themselves accordingly. For example, in a merger arbitrage, a fund might buy shares of a company being acquired and short the acquirer's stock. This approach requires careful analysis and timing, as the outcome of corporate events can be unpredictable. Merger arbitrage is a popular event-driven strategy. When a merger is announced, the target company's stock usually trades below the acquisition price due to uncertainty. Hedge funds buy the target stock and may short the acquirer's stock, betting the deal will go through. If successful, the fund profits from the price difference when the merger closes. However, if the deal falls apart, losses can occur. This strategy highlights the importance of research and risk management in hedge fund investing. Stressed securities strategies involve investing in companies facing financial trouble or bankruptcy. Hedge funds buy the debt or equity of these companies at deep discounts, hoping to profit if the company recovers or restructures successfully. This approach requires a strong understanding of legal and financial processes, as well as the ability to assess the likelihood of a turnaround. While risky, distressed investing can offer significant rewards for those who get it right. Relative value arbitrage is all about finding pricing inefficiencies between related securities. Hedge funds using this strategy look for pairs of assets that should move together but have temporarily diverged in price. By taking offsetting positions in these assets, funds aim to profit when prices realign. This approach relies heavily on quantitative analysis and often involves complex mathematical models. It's a favorite among funds with strong research and technology capability. Convertible arbitrage is a specialized form of relative value strategy. Hedge funds buy convertible bonds, debt that can be converted into equity, and hedge the associated stock risk by shorting the underlying shares. The goal is to profit from pricing inefficiencies between the bond and the stock. This strategy requires careful monitoring and quick adjustments, as market conditions can change rapidly. It's a classic example of how hedge funds use sophisticated tactics to seek out return. Quantitative, or quant, strategies use mathematical models and algorithms to identify trading opportunities. Hedge funds employing these methods analyze vast amounts of data to spot patterns and trends that may not be visible to the human eye. These strategies can be applied to equities, bonds, currencies, and more. The rise of technology has made quant strategies increasingly popular, allowing funds to execute trades at lightning speed and with precision. Statistical arbitrage is a subset of quantitative strategies. It involves using statistical models to identify short-term mispricings between securities. Hedge funds build complex algorithms that can execute hundreds or thousands of trades per day, seeking to capitalize on small price discrepancies. This approach requires advanced technology and constant monitoring, as opportunities can disappear in seconds. It's a highly competitive space where speed and accuracy are crucial. Managed future strategies involve trading futures contracts on commodities, currencies, and financial instruments. Hedge funds using this approach often rely on trend-following models, seeking to profit from sustained moves in market prices. These strategies can provide diversification benefits, as they often perform well when traditional assets like stocks and bonds are struggling. Managed futures are popular among funds looking to balance risk across different asset classes. Hedge funds don't stick to just one approach. Multi-strategy funds combine several investment tactics within a single portfolio. This allows them to adapt to changing market conditions and seek opportunities across different asset classes. By diversifying their strategies, these funds aim to reduce risk and smooth out returns over time. Multi-strategy funds require skilled managers who can allocate capital effectively and monitor multiple positions simultaneously. Risk management is at the heart of every successful hedge fund. Managers use a variety of tools to monitor and control risk, including stop-loss orders, position limits, and sophisticated analytics. The goal is to protect capital while still pursuing attractive returns. Effective risk management allows hedge funds to survive market downturns and capitalize on opportunities when they arise. It's a critical component of long-term success in the industry. Leverage is a powerful tool that allows hedge funds to amplify their returns by borrowing money to increase their investment size. While leverage can boost profits, it also increases risk. If investments move against the fund, losses can be magnified. Successful hedge funds use leverage carefully, balancing the potential for higher returns with the need to manage downside risk. Understanding how and when to use leverage is a key skill for any hedge fund manager. Short selling is a technique used by many hedge funds to profit from falling prices. By borrowing shares and selling them, funds hope to buy them back later at a lower price, pocketing the difference. Short selling can be risky, as losses are theoretically unlimited if the stock price rises. However, it's a valuable tool for hedging and for taking advantage of overvalued securities. Mastery of short selling is a hallmark of skilled hedge fund managers. Hedging is all about reducing risk. Hedge funds use a variety of techniques to protect their portfolios from adverse market movements. These can include options, futures, swaps, and other derivatives. By carefully constructing hedges, funds can limit potential losses while still participating in market gains. Effective hedging requires a deep understanding of financial instruments and market dynamics. It's a core skill that separates top-performing funds from the rest. Liquidity is a crucial factor for hedge funds. Some strategies involve assets that can be quickly bought or sold, while others may tie up capital for longer periods. Funds must carefully manage liquidity to ensure they can meet investor redemptions and take advantage of new opportunities. Poor liquidity management can lead to forced selling and significant losses, especially during market stress. It's a balancing act that requires constant attention. Hedge funds typically charge higher fees than traditional funds, often using a 2 and 20 structure, 2% of assets under management and 20% of profits. These incentives align the interests of managers and investors, encouraging strong performance. However, high fees can eat into returns, so investors must weigh the potential benefits against the costs. Understanding fee structures is essential for anyone considering investing in hedge funds. Hedge funds operate with less regulatory oversight than mutual funds, but they still face important rules regarding disclosure and investor protection. In recent years, regulators have increased scrutiny to ensure transparency and fair practices. Investors should be aware of the regulatory environment and seek funds that prioritize clear communication and ethical standards. Transparency builds trust and helps investors make informed decisions. Technology plays a vital role in modern hedge fund strategies. From algorithmic trading to advanced data analytics, funds leverage cutting-edge tools to gain a competitive edge. Technology enables faster execution, better risk management, and deeper market insights. As markets evolve, the importance of staying ahead technologically cannot be overstated. Hedge funds that invest in technology are often better positioned to adapt and thrive. Behavioral finance examines how psychological factors influence investor decisions. Hedge funds use insights from this field to anticipate market movements and exploit irrational behavior. By understanding common biases such as overconfidence or herd mentality, funds can position themselves to profit when others make mistakes. Behavioral finance adds another layer of sophistication to hedge fund strategies, blending human psychology with financial analysis. Emerging markets offer unique opportunities and risks for hedge funds. These markets can be less efficient, creating chances for skilled managers to find mispriced assets. However, they also come with challenges like political instability and currency risk. Hedge funds that specialize in emerging markets often have local expertise and strong risk controls. Investing in these regions can add diversification and growth potential to a fund's portfolio. Environmental, social, and governance (ESG) factors are becoming increasingly important in hedge fund strategies. Funds are integrating ESG criteria into their investment process, seeking to generate returns while promoting sustainability. This shift reflects growing investor demand for responsible investing and recognition that ESG factors can impact long-term performance. Sustainable investing is no longer a niche, becoming a core part of the hedge fund landscape. Fund of funds invests in multiple hedge funds rather than directly in securities. This approach offers diversification and access to a range of strategies and managers. However, it also comes with additional fees and complexity. Fund of funds managers must carefully select underlying funds and monitor performance closely. For investors, this can be a way to gain exposure to hedge funds with lower minimum investments and broader diversification. Due diligence is essential before investing in any hedge fund. Investors should thoroughly research a fund's strategy, track record, risk controls, and management team. Understanding how a fund operates and what risks are involved can help avoid unpleasant surprises down the road. Strong due diligence is the foundation of successful hedge fund investing and helps build confidence in investment decisions. Measuring hedge fund performance goes beyond just looking at returns. Investors also consider risk-adjusted metrics, such as the Sharpe ratio, to evaluate how much risk was taken to achieve those returns. Comparing performance to relevant benchmarks and understanding the sources of returns are key steps in assessing a fund's success. Accurate performance measurement helps investors make informed choices and set realistic expectations. There are many myths about hedge funds, such as the belief that they are only for the ultra-wealthy or that they always deliver high returns. In reality, hedge funds vary widely in their strategies, risk profiles, and performance. While some funds have delivered impressive results, others have struggled. Understanding the facts helps investors set realistic expectations and make better decisions about whether hedge funds are right for them. As we wrap up, it's clear that hedge funds use a wide array of strategies to pursue returns and manage risk. The industry continues to evolve, with new technologies, regulations, and investor preferences shaping its future. Whether you're considering investing or just interested in how these funds operate, understanding their strategies is key. hedge funds will likely remain at the forefront of financial innovation, adapting to new challenges and opportunities in the years ahead.